Well, how's it going, friends and family? It's time for another stock analysis. And today we're going to be talking about Medline, ticker symbol MDLN. Very boring business model that I think has a lot of potential. So in this video, I'm going to be breaking down my full analysis on the company. More importantly, I'm going to be sharing with you what I think the fair value estimate should be. So if you take a look at their stock market history, IPO'd back in December of 2025, hit a high of about $50 and some cents a share, and now they're roughly $34.26. So this dip, this valley, is it a good time to buy or not? That's what I'm trying to figure out. But first and foremost, who exactly is Medline and how do they make revenue? So Medline makes and sells medical supplies for hospitals, clinics, urgent care centers, and others in the healthcare space. They have over 335,000 SKUs of every accessory a hospital would use to keep it up and running, which includes gloves, syringes, surgical knives and scissors, and I think you get the drift. And when we consider the breakdown of their revenue based on the 2025 numbers, 48% comes from them selling their own branded stuff. And then 52% comes from being a supply chain distributor of medical equipment and supplies for other companies. And that line of business is known as MedTrans. So you can think of them as the FedEx, or I guess the UPS of the hospital universe. The logistics backbone that gives their own branded products direct and preferred access to hospital shelves. And from my understanding, major healthcare systems, they will partner with Medline as their medical supply partner so that their procurement can be as easy as possible without having to talk to hundreds or thousands of different vendors and suppliers. So their business model, it kind of reminds me of Fastenal in the warehouse and fulfillment center ecosystem, where they provide supplies and equipment directly to businesses while pushing their own higher margin private label products. In other words, it prints cash. And now let's talk about the recent developments surrounding the company. First and foremost, why did Wall Street punish Medline very recently? So they posted their latest earnings on August the 5th, and in terms of numbers, absolutely fantastic. However, friends and family, you should know that numbers, it's only half the battle. So what's going on? They're selling off because of inflation hurting their margins, tariffs being problematic, and a fire burning down one of their distribution centers in Tracy, California, which is right outside of the Bay Area. But after looking into it, I don't think it's going to be a make or break kind of thing, because they have 70 distribution centers in their portfolio, of which 45 are based in the US. And earlier this summer, another reason as to why they're selling off, Medline got in trouble with the FDA for not sanitizing its equipment properly and distributing supplies with bacteria on them. That's a big no-no. So they have to get those violations closed out ASAP. Otherwise, the FDA, they're going to slap them in the face, and they might even shut down their operations. But I'm pretty sure an operation at their scale, they're going to do whatever it takes to resolve those problems. And now let's go ahead and talk about the cheese situation. What are the three big considerations when it comes to Medline? The first one I have labeled as relationships and retention. So they have a little over 1,600 prime vendor relationships, meaning the healthcare customers, and they have a retention rate above 98%. So when you think about it, for every 100 health systems, hospitals, or nursing homes that rely on Medline as their primary medical supplies distributor, over the span of 5 years, 98 out of that 100 will choose to stay with them and continue to do business with them. And to put that into perspective, Costco's retention rate for customers remaining a member year after year, it's roughly 91%. So for Medline, a B2B operation, 98%, dude, that is phenomenal. When you think about it, very, very sticky, reoccurring customer relationships. And about a third of the products that they sell to their hospital customers are their own branded stuff. But reading between the lines, I think right now the game plan is to push their own private label stuff instead of trying to sell third-party products. And then number two, this one I don't really like, but it's a part of their DNA. They have private equity history. So 3 different private equity firms, Blackstone, I think we're all pretty familiar with them, Carlyle Group, and Hellman and Friedman, they purchased Medline in a roughly $34 billion leveraged buyout in 2021. And what's crazy is, as we just learned, they went public at the end of 2025. Now, in the business world, 9 out of 10 times, this is usually a red flag. Taking a public company private and then to just spit them back out as public, it's no bueno. The reason being is that a private equity firm will buy out a company, saturate it with debt, improve its operations because of all of the loans, and then a few years or quarters down the road, they'll IPO that company, which is a liquidity event for the private equity owners. So at a minimum, because they have this in their timeline, I'm a bit skeptical of the whole thing. Like, are they trying to offload their bags onto the public shareholders? Or is this actually a good, smooth running machine? And then the third thing I have labeled as headwinds with a question mark, and that's because of the variable of lower EBITDA going forward. So Medline, they manufacture roughly 35% of its branded catalog in North America. And then they outsource the remaining 65% to over 600 different global suppliers, like in China, Vietnam, and other places. A huge portion of those imported supplies internationally, they rely on petroleum-based plastics and synthetics. So the thing is, as oil prices stay high, Medline is going to get hit twice. Higher overseas production costs and elevated distribution and transportation costs. So it's going to compress their margins before inventory even reaches domestic distribution. In simplified terms, lower profits on the bottom line because the cost to do business is higher. And now we're going to go over the report card for Medline, predicated upon their financials and numbers. The first category is going to be the financial performance, and that's based on their P&L. Now, I love the revenue growth situation for them. It's pretty aggressive. But the return on invested capital, which is a metric that's really important to me, like how efficiently they're using capital, loans and shares outstanding, it's less than their weighted average cost of capital, the cost of doing business. And this is not a good thing. And that's because their debt situation, it is a bit concerning. And we'll talk more about that when we get to the balance sheet. However, it is trending in the right direction because they're paying down the debt from being super scary to now just being a little concerning. But more importantly, their profits per share have been exploding in the past 3 years. So all in all, I think Medline, it's a mixed bag, but a C plus I think is more than fair. Now, transitioning to the balance sheet, otherwise known as the books, the cash on the books, pretty interesting. Because in fiscal year 2024, they only had $278 million. And now, because of the IPO event, they have $2.7 billion. And by the way, they used some of the money that they made from the IPO to pay down their debt as well. And to see if they're truly drowning in debt, I referenced the debt to EBITDA, which tells us that, yeah, it's still pretty high. But compared to their own history, it is lower than usual. However, at a 4.2, I'm not happy with what I see here because the golden standard in debt to EBITDA should be around a 3 or less, meaning it should take a company about 3 years to pay off all of the loans on the books by only using their core operating profits if everything were to remain the same. So frankly, their books, a little disappointing. Yet, when you benchmark them against a peer, they just so happen to have a debt to EBITDA ratio of around a 4.9. So maybe it's an industry trend where higher debt levels is pretty much acceptable, kind of like the utilities and the REIT space. So overall, I think their balance sheet is a C, maybe even a C minus. Now the next category is the dividend safety. They do not pay a dividend, which is a shame. But their free cash flow per share is going to be a very good proxy to determine the cash being generated for shareholders like you and me. And their free cash flow situation is absolutely cinema. It's beautiful. It's what a compounder would pull off. And as a general rule of nipple, the free cash flow per share is the actual cash a business pockets after baking in the operational expenses. Whereas on the other hand, the earnings per share, the profits per share, it can be financially engineered according to accounting standards by utilizing one-time tax write-offs or asset write-downs or tariff refunds or other financial manipulation. So you can make your profits look worse or better depending on how you cook it. But the free cash flow per share, you can't do none of that. So based on the free cash flow situation, I would say it's an A+. Now, transitioning to the last category, valuation. Are they overvalued, undervalued? It's a little difficult considering they just IPO'd, right? There's not much timeline or history to work with. However, operating off the PEG ratio, if you take their current PE ratio based on the trailing 12 months of profits per share of about 43, and you divide it by the growth rate of their profits per share, which is 998, it gives us a PEG ratio of a 0.04. I'll repeat that, a 0.04. Friends and family, if a company has a PEG ratio of around a 1, they're undervalued. To be a 0.04, on paper, they are extremely cheap relative to its growth rate. And then if we apply the price to free cash flow ratio instead of their earnings, which is going to be $34 per share divided by $1.76 of free cash flow per share, then we get a 19.3. And between you and me, I think that's a lot more digestible than the PE of a 43. So to have a 19.3 free cash flow ratio, I think when it comes to their valuation, I think it's an A+. However, we cannot say with pure confidence that they're undervalued unless we figure out their inherent worth, which we're going to do next. Now, based on the GARP formula, which is contingent upon their revenue growth rate, if we bake in 8% for the foreseeable future, then Medline should be around $38.41 if their top line grows at 8%. And if we're very optimistic and we bake in 12%, then Medline should be $55.25 right now. However, based on the most recent earnings, the leadership team, they're forecasting about 10% growth. So shaving a little bit off of that, and let's say they pull off 9.5% growth in the top line, then Medline should be $44.09. Now, if we refer to another inherent worth calculator, discounted cash flow analysis, and we discount it at a rate of 7%, then Medline should be $39.27. And last but not least, if we look at the milk to margin model, which is based on their future PE ratio, then their 2026 fair value should be $40.58. Right now, they're roughly $34, $33, depending on when you watch this video. And so when we think about the valuation gap, where they are right now and what their inherent worth price is of about $41.31, I think Medline, they're slightly undervalued because the upside is 21.5% to reach their fair value. But just because they're undervalued on paper, it doesn't mean the market will ever agree with me. Sometimes in undervalued business, they could continue selling off, and that's just the reality of the stock market, despite their financials and fundamentals being rock solid. It's just something that I've experienced as an investor. Like I saw this firsthand with PayPal. They were executing pretty good numbers, awesome free cash flow, just everything about their numbers, metrics looked really solid, except probably the pay take rate. That number was declining year after year, but I don't think PayPal should have been a freaking 3 or a 4 PE ratio as a valuation. So it could happen, a sell-off despite good numbers. And personally, between you and me, I'm not a lump sum type of investor, despite the data saying that it's the better route to go. I prefer to dollar cost average. And so if I were to buy into Medline, like I made up my mind, I have to have them, a good price for me to open up an initial position, roughly 10% of my capital, would be around $32. And then in bargain price, when I would deploy about 25, maybe 30% of my capital, is when they reach $28 a share. And then if I'm truly in love with Medline, and I think they have a really bright future, when is it time to back up the truck so I can load up as much as I can? Roughly $25 a share. And now, friends and family, it's time for the compounded curve. We're going to be comparing Medline against the competition. Various companies that we have covered and analyzed on this channel, and we will be placing them into a grade bucket. S is obviously the highest caliber, excellent. C is average, and F, atrocious. This is based on the US grading scale. Now, how good is this business? That's the determining factor for what grade they will receive. Well, Medline, they have over 50 years of consecutive top-line growth. So when you bake in all of the recessions and catastrophic events, they kept growing their gross sales year after year. And they operate in a landscape that I am very bullish on, which is health care. And in terms of an economic moat, well, they do have fierce competition from several publicly traded entities. One is Ascendra Health, formerly known as Owens & Minor, that's headquartered in Virginia, Cardinal Health, and McKesson. But according to market research, Medline has the biggest market share in selling and distributing hospital supplies at about 28% of the market penetration here in the US. I think some of their competitors, they focus more on transporting pharmaceutical stuff, but they also do hospital supplies. And something I forgot to mention earlier is the geographic breakdown of where they make money. So Medline, they make 93% of their revenue in the United States, and only 7% comes from the rest of the world. To me, as you guys know, I feel really bullish about the American economy, especially in the future. So to me, that's the perfect ratio, because the US healthcare system is responsible for 18% of the US GDP. In other words, a very bright future. So for Medline, after taking a look at them, sitting with it, and pondering, are they a good compounder, or are they going to be in the Kager graveyard right next to gambling.com? I think Medline is a solid B-. Sorry, going on to the next slide. And they would be right next to MP Materials, Texas Instruments, Oracle, United Health. I think they're above average. I think a case could be made for C+, but I think with the growth of their free cash flow and earnings per share being a triple-digit percentage, it's high caliber. But I think what weighs them down is their debt. But if they continue to pay down their debt and their debt to EBITDA turns into like a 3.5 or a 3 in the next 1 to 2 years, they could easily be a solid B instead of a B-. So who is this stock for? Well, they don't pay a dividend, so it's definitely not for an income investor. So I think Medline, it's a GARP stock for sure. Growth at a reasonable price. And it's not just growth. You get high growth in their earnings without too much downside ugliness, because they operate in a landscape that's really recession-proof. So you get about 10% organic revenue growth year over year in a very defensive operating landscape. And the best part is it's not some speculative startup that just GTM and now they're hitting the ground running. No, they've been around for a hot minute. So when it comes to the cheese rating for Medline, do I think they're delicious, decent, or are they moldy cheese? In other ways, do I actually want to own Medline right now as a stock in my portfolio? Well, to back it up a little bit, when I think about Medline, it's the exact same thesis as Abbott that I disclose in the public portfolio series, except not so focused on heart-related products and accessories, because Abbott is more so of a medical device conglomerate, and they do sell like nutritional drinks and everything else. Medline, they do not sell anything that you can consume. But I digress. So just like Abbott, general hospital visitations from an aging population on Medicaid and Medicare. Every single year, we're getting thousands of folks that are turning 65, 66, 67 years old, and they transition from whatever health insurance plan that they were on to Medicare. And the older that you get, the more care that you have to seek. And the United States population is getting older by the day because people are living longer than ever. So hospital supplies and equipment, very bullish on. And to service the folks properly, Hospitals have pretty strict protocols where you cannot reuse gloves or handle a tool beyond its useful life. You can't reuse a syringe. You know what I'm saying? You're going to have to constantly replace and replenish that inventory in the hospital. And something worth calling out is in their 10K, the annual report, Medline makes it crystal clear that I think in the next like 2 to 5 years, they're going to be aggressively swapping out third-party products for their own branded stuff. And that's going to hit their revenue. It's the exact same playbook that we're seeing with Costco, Walmart, and Amazon prioritizing their own private label branded stuff. Now, why would their revenue go down because of this? Because the MSRP, how much they're going to sell their own branded stuff, it's going to be cheaper. So let's say they sell and deliver a third-party product and it's about $100. So they pocket $100 into their gross sales, but because of the overhead cost, the cost of goods sold, and everything else to run the business, they only actually keep $10 in profit. $90 of it goes right back to the manufacturer themselves, to their transportation team, insurance, rental costs, and everything else. So $10 profit off of $100 in revenue. But let's say they sell a Medline equivalent, their own private label product, they'll sell it for only $80, but because it's their own stuff and they can cut out the middleman, the third-party supplier, they actually pocket $20 in profit. So the revenue goes down by 20%, but the profit goes up 100%. Does that make sense? $10 of profit versus $20 of profit. So this is a company where the bottom line will tell a more accurate story than the revenue in the next few years. Like they literally told us, full transparency, the revenue will take a hit, but our EPS, our net income, it's only going to get better and better. I mean, in the face of tariffs, inflation, and all the other stuff that's going on. So maybe not the most aggressive growth in the next year or so while we wait for the price of oil to come back down, but 2 to 5 years, EPS more important than the gross sales. All that to say, I think I like Medline. In fact, I would want to add them to the cheese portfolio at only the right price. Now, I don't know if they're the best deal on the market right now, but they're pretty up there for me. I think Meta looks pretty good at its current price point of around like $520 a share. I also think Constellation Energy, the nuclear giant, pretty attractive. I also like Walmart. After they reported their earnings, they sold off by 10%, and they continue to go further into the red. But even then, I still think they're overvalued by a bit. They would need to drop a little further before I would consider them. And then I also like Sony out of Japan. They've got my attention. And by the way, I share my target buy prices for all of these watch list stocks on the Patreon if you're interested in something like that. Now, I know I said a lot, but please do keep in mind that I don't know what I'm talking about. All of this is wrong and inaccurate, so please do your own research and due diligence so that you can formulate an opinion on the company Medline. Just because I made a dedicated deep dive video on the stock, it does not mean I endorse or recommend it. And by the way, I also uploaded the newest episode in the Cheese Public Portfolio series if you guys want to know what I added and deleted, and front and center will be the trade desk. Now, having said that, I love you guys. Stay safe, stay strong mentally, and I hope you have a really good rest of your week. And good luck in the stock market. Talk to you guys really soon. Peace.